Okay. Good morning, everyone, and welcome to our enrichment webinar on tax credits and the marketplace. This is going to be a pretty short webinar today to give you just some additional information on tax credits and how they work. So please don't hesitate to raise your hand to ask some questions. You can also use the chat box to ask some questions. I do have that up and I will be monitoring it. So good morning, everyone, and welcome. Our agenda today is we're going to go over some key highlights on things that you should know. We're going to talk about financial assistance eligibility, and then we're going to dive into premium tax credits. We're going to talk about using those premium tax credits, definitions, expected premium tax credit contributions or expected premium contributions from the enrollee, calculating those advanced premium tax credits, and then applying advanced premium tax credits to the plan's premium. And then we'll go over how reconciling those tax credits when filing taxes works. And then we'll end with looking at some tax filing resources. So we'll just take a couple minutes here to highlight some things that you should know. And we'll probably pay a little attention to them as they pop up throughout the next several slides. So eligibility rules have changed specifically for the family glitch fix. We just wanted to highlight that. So people who were not previously eligible to enroll in the marketplace, in a marketplace plan and get financial assistance. So financial assistance meaning advanced premium tax credits because they were eligible to be on an employee group health plan. They're now eligible to enroll in the marketplace because they now look at eligibility for the marketplace for each person in the household, not just the employee that that is eligible for the employee group health plan. So they used to just look at the employee that's working that gets the employee group health plan. And if the other people in the household were eligible to also be on that employee group health plan, if it was just affordable to the employee, then the other people in the household were not able to get a marketplace plan, even if that employee group health plan was unaffordable for them. But now they look at the employee alone, and then they look at the other people in the household. So if it's affordable for the employee to get an employee group health plan, but it's unaffordable for the rest of the family in the household to be on that employee group health plan, they now have the ability to get financial assistance through the marketplace and get those advanced premium tax credits. So that was a big change that happened in the end of 2022. Also, we want to make sure that you know healthcare.gov calculates the affordability of the plan so that you don't have to. It calculates the affordability of the employee group health plan. So that's not something that you have to learn how to do or know how to do. The higher someone's income is, the less financial assistance they're going to receive. And that means it's because they're going to be expected to contribute more towards their premium. So they'll receive less financial assistance. Financial assistance is always going to be based on their estimated income. So when they're doing their application in healthcare.gov, that income that they put in is always going to be estimated income, which is why reporting changes throughout the year is so important. Changes like maybe a promotion, a job change, any kind of change in income that could change someone's eligibility for the amount of financial assistance they're receiving is going to be really important to report in that healthcare.gov application. It looks like there is a hand up. Do you have a question, Marissa? Here, I have it so that you can talk if you want to ask a question. You just have to unmute yourself. Marissa, did you want to ask a question? You could also put it in the chat. Oh, okay, perfect. I just didn't want to skip over you if you did have a question. All right, so let's move on to the next slide. Now we're going to talk about financial assistance eligibility. So the only way someone can get financial assistance from an individual plan is to enroll through the marketplace or healthcare.gov. So you must purchase the plan on healthcare.gov. They also must file taxes. If married, they must file taxes jointly. The only exception to this is if they call healthcare.gov and file or have the exception due to spousal abuse or abandonment. There is that exception because we don't want someone who is in that situation to have to contact their abuser to file taxes. So, but in most situations, a married couple must file taxes jointly to be able to get financial assistance through the marketplace. To get financial assistance through a marketplace plan, someone must not be claimed as dependent on someone else's taxes. They would need to file their own taxes and not be a dependent on someone else's taxes. They would also need to not have access to other affordable health coverage. What that means is they would need to not have access to an affordable employee group health plan. They would need to not have access or be eligible for Oregon Health Plan. They would need to not have access or be eligible for like TRICARE or CHAMP VA or Medicare. Also, eligibility for financial assistance is based on the amount and type of assistance. It really depends on the estimated income that you put in that healthcare.gov or marketplace application. So that's always, the amount is always going to be determined based on that estimated income. Any questions so far? Okay, perfect. So there's two types of financial assistance that is available through the marketplace. And to answer a question in the chat really quickly, Caroline, I believe if they are legally separated, I will have to look that up for you. I still think they have to file taxes jointly, but I'm not 100% positive. So if you could send me an email, I could reply back and let you know and find out for sure. And I'll go ahead and send my email for you really quick. Okay. So there's two types of financial assistance available for marketplace plans. There's advanced premium tax credits, and that offsets the cost of the plan's premium every month, with part of the premium being paid in advance, and that's financial assistance. So it offsets the cost of the premium by using advanced premium tax credits. The next type of financial assistance is cost sharing reductions. And that financial assistance lowers the cost of the out-of-pocket expenses when utilizing a health plan. We're going to have another enrichment webinar specifically to go over cost sharing reductions. So keep an eye out for that one. And that will be upcoming here in the next couple months. So there's two different ways someone could choose to use premium tax credits if they are eligible for advanced premium tax credits based on their estimated income. So they could use premium tax credits in advance, which is the way the majority of individuals use premium tax credits, which is why you've probably noticed that I keep calling them advanced premium tax credits, is because people generally use them in advance. So how that works is the IRS advances the premium tax credits to the insurer, and then the consumer or the client pays the rest of the premium to the insurer. So the insurer is getting the full amount of that plan's premium in combination from the IRS and the insured. And then at tax time, the IRS reconciles with the individual to make sure that the individual doesn't owe the IRS money, or the IRS doesn't owe the individual any of those tax credits back based on how much they actually made or didn't make from that estimated income that they reported they thought they would make. The second way someone could use premium tax credits is they could find out on healthcare.gov that they're eligible for, let's say, $800 a month in premium tax credits. And instead of using that in advance, like the left-hand side of the screen, they could choose to not use any at all in advance and pay for their premium for their health plan in full every month. And then at the end of the year, when they file their taxes, the IRS would owe them all of those premium tax credits based on their income that they actually were eligible for, and they would receive that in their refund from the IRS. So they could get it all in one lump sum at tax time versus in advance monthly to help offset the cost of their premium. Are there any questions on this slide before we move on? All right. So there is some terminology that we should talk about before we move on to the next couple slides. So what is a benchmark plan? A benchmark plan is a plan that we're going to refer to when calculating expected premium contributions. A benchmark plan is the second lowest cost silver plan available for an individual in the area that they live. Keep in mind, when we talk about expected premium contributions, this isn't something that you're ever going to be expected to know how to calculate. We're just giving you the information so that if someone asks you questions, you can be more familiar with what actually goes into how these things are calculated. Healthcare.gov will always do all of these calculations for you. So this is just to help you be more familiar and comfortable with how the back end of this process with tax credits work. So a benchmark plan, it is the second lowest cost silver plan available to someone in the area that they live. Expected premium contribution. That is what a tax household is expected to pay towards or contribute towards the cost of their premium or the cost of their plan. And that's going to be based on the estimated annual income that they put into their healthcare.gov application and the federal poverty level. And we do have a chart of different poverty levels. So they're going to look at that estimated reported annual income that the individual thinks they're going to make and where they fall into that chart for the federal poverty level. And that's going to give them the expected premium contribution that they would pay towards their plan. And again, all this is calculated for you on the healthcare.gov application or for the client. And then there's the premium tax credit, which is what we're here to learn about today. So the premium tax credit is going to be the difference between the cost of the benchmark plan in their area. So that second lowest cost silver plan and the expected premium contribution of an individual, which remember that's their annual estimated income and where they fall into that federal poverty level percentage, what they're expected to pay. So the difference between the benchmark plan's premium and their expected premium contribution is going to be how many premium tax credits they're eligible for. And then this next slide, I'm going to show you what that looks like. So here's how it's calculated. So this means a second lowest cost silver plan. That's what that acronym is. So this is going to be the cost of that second lowest cost silver plan, the benchmark plan, minus the expected premium contribution for this individual is going to equal how much premium tax credit they're eligible for. So this individual, how they would get their expected premium contribution is their estimated annual income. You'd find out where it falls in this annual household income percentage of the federal poverty level. So you would look at that income on a chart and you would see on the chart that it's, oh, you're at 200% of the federal poverty level. And you could see here an individual between 200 and 250% of the federal poverty level would be expected to contribute 4% of the premium for the second lowest cost silver plan. So what that would look like is this situation here. So let's take a look at this. So we're going to look at a single person living in Eastern Oregon. This person has an annual income of $26,182, which happens to fall in to that federal poverty level of 180% of the federal poverty level. Because of that, see down here at the very bottom, someone between 150 and 200% of the federal poverty level, they're expected to pay 2% of their income towards their plan's premium, or the second lowest, the benchmark plan's premium is how much they would be expected to pay of their estimated income. So what that looks like is $524 a year or $44 a month. You can see here the second lowest cost silver plan is $519 a month. So let's see this next slide. So based on that information, if the second lowest cost silver plan is $519 a month, and 2% of that is $44 a month, because that's how much she would be expected to pay. That's how much is affordable to her based on her percentage of the federal poverty level. That would mean she'd be eligible for $475 a month in premium tax credits. She would be able to apply that $475 a month if she chooses to take it monthly instead of one lump sum when she files her taxes to any of these plans. She doesn't have to apply it to the second lowest cost silver plan. That's just how they calculate how much she would be eligible for. She can use that $475 in tax credits towards any plan. So if she picked this bronze plan, the full cost of the benchmark plan is $369 minus the premium tax credit, which is $475, which would mean she would still have $1 premium. Does anyone want to take a guess as to why she would still have $1 premium, even though the tax credits she's eligible for are larger than the actual cost of the plan? Anyone want to take a guess? Okay, I will answer it. The reason for this is because the state of Oregon has 2 additional benefits aside from the 10 federal essential health benefits that we have mandated we want all plans in Oregon to offer. And those 2 benefits are acupuncture and I forget what the second one is. Acupuncture, and does anyone know what the second one is? I forget what the second one is. But because we offer those 2 extra benefits that we have all plans cover, yes, chiropractic, thank you. Acupuncture and chiropractic, because we have plans offer those 2 additional benefits, we have to charge at least $1 for every plan. And you can see here, if she goes with the silver plan, it's going to be a $44 a month premium that she'll still have to pay. And if she goes with a gold plan, she would have to pay $94 is the difference between the cost of the plan and the premium tax credits that she would be eligible for. And she can choose out of that $475 in tax credits, she can choose to use the full $475 each month. She can choose to use 400 of it. She can choose to use none of it and get the lump sum at the end when she files her taxes. Any number in between. Because at the end of the year, when she reconciles her taxes, any amount that she actually was eligible for that she didn't use, she's going to get a refund for. So someone, if they don't feel comfortable because they're worried their estimated income might actually be more than what they're estimating, and they're worried they might have to pay advanced premium tax credits back, they always have the option of giving themselves a little buffer and maybe choosing to take 425 of that 475, just to give themselves a little buffer monthly in case they do end up making more than they thought. And then they wouldn't have to pay that money back. It looks like we have a question here. Please correct me if I'm wrong, that in the case the member would pay full price, that she would receive $475 a month in a tax refund. That is correct. Based on their estimated income, if their estimated income was correct and they were indeed eligible for $475 a month, then yes, at the end of the year when they reconciled their taxes, they would get all of that back, $475 times 12 in their tax refund. If they stated that they were going to make more than they actually did, and let's say this individual was actually eligible for $550 in advanced premium tax credits a month, then when they file their taxes at the end of the year, they're going to get the $550 a month times 12 back as a refund if they didn't take any of it during the year. So that's why tax credits are reconciled at the end of the year, is to make sure that you actually got all that you were eligible for, or if you ended up making way more money than you thought you were going to, that you had the correct contribution towards the cost of your plan, and then you paid toward it at the end of the year. By January 31st, following the plan year, every individual who is enrolled through the marketplace is going to receive a 1095A form. This form is like a W-2 in that it is filled out by the marketplace. The client's going to need to use this information on this form to complete their taxes. So every time I refer to reconciling their taxes, that means that they're going to need this form to do that. It's going to assist them with reconciling those premium tax credits that they received throughout the year or chose not to take throughout the year, and now they're reconciling it to get that lump sum. So if you have a client who has not received their 1095A form through the marketplace, they need to log into that healthcare.gov portal and retrieve it. That's where they are sent, is through healthcare.gov. So the individual would need to log into their account, go to the message center, after January 31st, and that's where they would get this form. If they were in another program during the year, also like public medical benefits or employed offered coverage, these are the other two forms that they would receive. By no means are you tax experts, and we certainly don't expect you to be, but we also want you to be familiar with where to see excess or repayments of those advanced premium tax credits. So on this tax form 8962, that's the form that's used to reconcile the premium tax credits. And at the bottom of the form, you'll see an area that's going to show if the client is getting additional premium tax credits or if they're having to repay some of those premium tax credits that they have already used. This is not a form that we expect you to know how to fill out. As a matter of fact, we encourage you to refer people to a tax professional if they are needing help filling out their taxes. However, it's useful to know where this information is located. A lot of times we hear people say that they had to pay back all this financial assistance that they received, but that is very rarely the case. Usually people don't realize that the amount they're paying back is being added into any other taxes that they may owe the IRS. And so it's easy to think that their whole amount they owe the IRS could be the fault of they have to pay back their premium tax credits, when that is generally not the case, because the amount that they have to pay back in premium tax credits is limited based on where someone falls in their federal poverty level. So let's say someone way overstated, understated their income. And so they got way more tax credits than they were actually eligible for. And it was a single individual, and they were at 205% of the federal poverty level, and they actually were overpaid, let's say $2,000. They made $2,000 more, or were given $2,000 more in advanced premium tax credits than they were actually eligible for. They're going to be limited to only having to repay 900 of that. So there are limitations, and you can see them here. Are there any questions so far before I move on to the last slide? And I just want to remind you that a really good way that people can avoid having to owe anything back for their advanced premium tax credits is, one, if they happen to mid-year qualify for other affordable health coverage, it is always really important that they be proactive and cancel their marketplace plan once their new coverage is confirmed. Marketplace plans don't just cancel themselves. The insured has to take action to cancel their plan. So if they now are eligible for Oregon Health Plan, then they're going to need to, once their Oregon Health Plan starts, call the marketplace and cancel their plan. If they get a job that offers employee group coverage, they're going to need to call the marketplace and cancel their plan. This is to avoid having their plan continue receiving those advanced premium tax credits, and then at the end of the year having to repay those because they actually had another affordable plan in place. Also, if someone gets a raise, that's going to be reflected on their tax forms at the end of the year, and when they reconcile, they're going to see that they were not eligible for as many tax credits as they originally thought they were going to be. And so if they were to report any income adjustments or changes, that would also be a way to avoid having to repay any tax credits at the end of the year. And on the flip side, if someone switches jobs and maybe their income changes and goes down, it would be really helpful to report that income change so that they could receive more premium tax credits to help make their premium more affordable if their income went down. If So we have a question. It says, I believe they can cancel the plan from their account instead of calling the marketplace, right? If someone wants to cancel the plan for every person who is covered on the plan, yes, they can do that through their healthcare.gov account. If they, let's say, there is a married couple with a couple children, and one of the parents is eligible for an employee group health plan because it's affordable, and they need to be taken off of the marketplace plan. But the other individuals in the household, it is not affordable for them to be on that employee group health plan and they need to stay on a marketplace plan, then you would need to call the healthcare.gov call center to have the one person removed. If they were to do it through their healthcare.gov account, it would cancel the plan for everybody in the household. So healthcare.gov, they can cancel if it's for the whole entire plan. They need to call the marketplace call center to cancel one or two people off a plan, but they don't want to cancel the whole plan. So that's a really good question, and thank you for asking that. All right, here's our last slide. We just want to make sure that you know resources. So if someone needs help filing taxes, we do have some really good resources available that we know about. So there's that AARP tax aid. There's volunteer income tax assistance. There's other ones like My Free Taxes, MFS Cash Oregon. There's also the Oregon Taxpayer Advocate Office 2024 Free Tax Help interactive map. So we just want to make sure that you also know that we do know of these resources and want to make sure that you know of them as well. And I'm just going to look through the chat and make sure I'm not missing any other questions. And someone was asking a specific question about advanced premium tax credits. So they're asking if someone is at, here's on this slide, 200% of the federal poverty level, and they're getting $800 a month in premium tax credits. And at the end of the year, it's determined that they only qualified for $200 in premium tax credits a month. And they were actually at 300% of the federal poverty level. Instead of owing the 7,200 back, they'd only pay 3,000. Is that correct? Yes. If it was a single person, their limit would be $1,500. And if it was a married individual, it would be 3,000. So yes, that is correct. Thank you for putting that into an example. Okay, do we have any other questions before we wrap up our enrichment webinar? All right. Well, thank you all for joining me today and the marketplace team and taking a half an hour out of your afternoon to learn more about premium tax credits in the marketplace. And please don't hesitate to reach out to us if you have more questions, and keep an eye out for the next enrichment webinar that will be coming available soon on cost sharing reductions. Thank you all so much again, and I hope you all have a very wonderful day. And enjoy the sun. It looks like it's going to be a pretty day here in Salem, Oregon anyway. So I hope that's the case everywhere you're at.